Let's get straight to it. The world of European stocks is buzzing with a new, headline-grabbing forecast that could impact millions of investors, both big and small. Citigroup, one of the world's biggest and most influential banks, has just made a bold prediction for Europe's main stock market index, the STOXX 600. This isn't just another routine update. This is a statement that's making waves across the financial community. According to Citigroup's latest analysis, they're forecasting the STOXX 600 index will reach 640 points by the end of 2026. That's a potential rise of about 10.5% from where it's expected to be in December 2025. For context, that's a significant jump for such a broad index, which tracks hundreds of leading companies across Europe. This isn't a wild guess or a shot in the dark. It's a carefully calculated projection based on deep analysis by some of the top financial experts in the industry. These analysts pore over economic data, company earnings, and global trends to make their calls. When a financial giant like Citigroup speaks, the entire financial world pays close attention. Their predictions can influence markets, shape investment strategies, and even affect the mood of investors everywhere. This forecast signals a strong sense of confidence in Europe's economic outlook. And that matters for anyone with investments, a pension, or even just a savings account tied to the market's performance. A 10% rise in the STOXX 600 could mean a healthy boost to your retirement savings, your investment portfolio, or even your future financial security. It's not just about traders in suits or big institutions. It's about the real value of our long-term savings and how these predictions can affect everyday people across Europe and beyond. But remember, this is a forecast, not a guarantee. The market can change quickly, and unexpected events can always shake things up. It's important to stay informed and cautious. Still, understanding why Citigroup is so optimistic right now can help all of us make smarter, more informed decisions about our money and our future. So let's break down what's really behind this big prediction and explore what it could mean for you, your investments, and your financial goals. First, what exactly is the STOXX 600, and why does it matter so much to investors and the European economy as a whole? The STOXX 600 is a stock market index, a single number that tracks the performance of 600 of Europe's largest and most influential companies, spanning across 17 different countries. It's a powerful tool that gives investors, analysts, and even everyday people a quick sense of how the European economy is doing as a whole. Think of it as a giant basket filled with shares from some of the biggest and most recognizable names in the UK, Germany, France, Switzerland, and many other European nations. This diversity means the index isn't tied to just one country's fortunes. It reflects the collective strength of Europe's corporate giants. Instead of tracking each company individually, the STOXX 600 gives you a single, easy-to-read snapshot of how Europe's largest businesses are performing overall. It's a way to see the bigger picture without getting lost in the details of hundreds of separate stocks. The larger the company, the more it influences the index, so global giants like Nestlé or LVMH have a much bigger impact on the STOXX 600's movement than smaller firms. Their successes or struggles can sway the index noticeably. When Citigroup predicts the STOXX 600 will rise, they're essentially saying that the combined value of these 600 companies is expected to grow. This could be due to stronger earnings, positive economic trends, or increased investor confidence in Europe. The STOXX 600 is also the benchmark for most European equity funds. If you invest in a European fund, your fund manager is likely aiming to outperform this index, using it as a yardstick to measure success. That's why the STOXX 600 is such a key measure of Europe's economic health. It's a crucial number for investors, economists, and policymakers who want to gauge the continent's financial pulse and spot emerging trends. So, why is Citigroup so optimistic about Europe's prospects right now? What's driving their positive outlook for the STOXX 600 and, by extension, the European economy? Let's dive in and explore the major factors and big drivers behind their forecast for growth in the STOXX 600. Citigroup's optimism is built on two main forces: government spending and central bank policy. These two drivers are working together to create a more supportive environment for European markets, and they're fueling a sense of renewed confidence among investors and businesses alike.
We remain constructive on European equities, supported by fiscal spend and lagged impacts of monetary easing. The combination of these factors is setting the stage for a period of sustained growth and opportunity across the continent.
In plain English, that means governments are spending more, injecting fresh capital into the economy through new projects, social programs, and direct support for industries that need a boost. At the same time, central banks are making it cheaper to borrow by lowering interest rates, which helps unlock credit for both businesses and consumers. When governments invest in infrastructure or green energy, it pumps money into the economy, boosting jobs and profits. These investments don't just create immediate work, they also lay the foundation for long-term growth and innovation. Central banks, like the European Central Bank, have cut interest rates, making loans cheaper for businesses and consumers. This move is designed to encourage borrowing, spending, and expansion. This encourages spending and investment, which helps companies grow. As people and businesses feel more confident, they're more likely to make purchases, hire staff, and invest in new ventures. The effects of these policies take time to filter through, like a radiator slowly warming a room. It's a gradual process, but over months and years, the impact becomes clear. Citigroup believes the benefits of recent rate cuts will keep boosting the economy into 2026. They expect these positive effects to build up, supporting growth for several years. That's why they see brighter days ahead for European stocks. With both government and central bank support, the outlook is more positive than it's been in years. Let's dig deeper into how government spending is creating these fiscal tailwinds, and why this matters for the future of Europe's economy. Fiscal tailwinds mean government spending is pushing the economy forward. Citigroup highlights Germany's big spending plans as a prime example. When Europe's largest economy invests in infrastructure, the effects ripple across the continent. This spending benefits construction, engineering, and raw materials companies, many of which are in the STOXX 600. It also boosts business and consumer confidence, encouraging more investment and spending. The money circulates through the economy, creating a multiplier effect. Citigroup sees these government-led investments as a solid foundation for business growth. They believe this will help drive higher corporate revenues and profits. Fiscal tailwinds are a key reason for their positive outlook. But government spending isn't the only factor. Central bank policy matters too.
The European Central Bank's main tool is the interest rate, the price of money. When the ECB cuts rates, borrowing becomes cheaper for banks, businesses, and consumers.
Lower rates mean companies pay less on existing debts and can borrow more affordably to expand. For investors, low rates make stocks more attractive than savings accounts or bonds, driving up share prices. The STOXX 600 has already benefited from ECB rate cuts in 2025.
The full impact of these cuts takes time. Businesses plan new projects, families refinance mortgages. Citigroup expects these delayed benefits to keep supporting company earnings through 2026. That's a big reason for their bullish target. So, how does Europe stack up against the US? Let's compare the STOXX 600 to America's S&P 500. The context matters.
The STOXX 600 and the S&P 500 both had strong years in 2025. The STOXX 600 rose 14%, but the S&P 500 did even better, up 16.6%. U.S. stocks have outperformed for years, thanks to tech giants like Apple and Amazon.
But Citigroup's forecast suggests Europe could be catching up. Europe's market is more focused on banks, industrials, and consumer goods, sectors set to benefit from recovery and government spending.
The economic conditions in 2026 may play to Europe's strengths. The performance gap could narrow, or Europe might even take the lead. That's why investors are taking a fresh look at European stocks.
What really drives share prices is profit growth, earnings.
Citigroup expects a strong rebound in earnings for STOXX 600 companies in 2026. 2025 was flat for profits, hit by tariffs and currency swings.
Those headwinds are easing. Companies have adapted, and currency impacts are fading. With these drags gone, businesses can grow faster. Citigroup forecasts over 8% earnings per share growth for the STOXX 600 in 2026. That's a solid reason for share prices to rise. This isn't just optimism. It's based on real improvements in business performance. The predicted earnings recovery is the engine behind Citigroup's bullish target. But which sectors are set to benefit most?
Citigroup's analysis highlights specific sectors set to outperform.
They're bullish on cyclical sectors, industries that thrive when the economy grows.
They've upgraded basic resources, mining and raw materials, thanks to infrastructure spending.
Industrials are also favored as they supply the machinery and equipment for new projects.
Banks and travel and leisure remain overweight, benefiting from economic recovery and increased spending.
But they've downgraded European tech stocks to neutral, citing high valuations.
It's not that tech is bad, but other sectors offer better value right now. Citigroup sees more upside in traditional, cyclical industries for the year ahead. For investors, this means looking beyond tech to sectors set to benefit from Europe's recovery. The right sector mix could make a big difference in returns. So, what does all this mean for your money? Let's wrap it up.
So what should you do with this information?
Don't make drastic changes based on one forecast. Stick to your long-term plan.
But it's a good time to check where your money is invested, especially in your pension or savings. If you have European shares, this forecast is encouraging.
Hands-on investors might consider whether they have enough exposure to Europe or the sectors Citigroup highlights.
The key lesson is diversification. Don't put all your eggs in one basket. Citigroup's outlook shows other regions can shine, not just the US.
Spreading investments across regions helps smooth out risks and capture growth wherever it happens.
The big takeaway: cautious optimism for Europe, thanks to government spending and central bank support.
Understanding these trends makes you a more confident, informed investor. And that's a valuable return in itself.